And I think you're going to have this major shift to Bitcoin as truly the digital gold. I mean, I think you're seeing more and more money that will ultimately come out of gold, and you're going to see that ratio disproportionately shift into Bitcoin because it's been the single greatest asset that we've seen, and it solves a lot of the problems that physical gold has, including weight and transferability and so many other things, right? The ability to monetize, speed of monetization, and so again, you're going to see crypto literally change every aspect of our financial system, and it couldn't come quickly enough. I think we're wholly behind.
Yeah, in 2026, if Bitcoin gets to 200 or 250,000, it would be breaking the 4-year cycle. So that's sort of part of our view is that this, if you follow the 4-year cycle, Bitcoin should be down this year. But I think that there's tailwinds that are building. And part of it is we kind of reset leverage on October 10th with that big shock.
Right.
And now I think there is still institutional adoption taking place, and Wall Street is still building a lot of products on the blockchain. And then we have U.S. government support. So I think these are tailwinds that help Bitcoin recover this year.
And even though people have pointed out the divergence from gold and silver, you think with gold and silver doing well, eventually Bitcoin benefits from that trade?
Yeah, it does look like gold rallies typically lead Bitcoin rallies. So I think it's been healthy for gold to rally. Part of it's, dollar debasement, and now with monetary easing, those are things that are supportive of crypto to follow. And as you know, crypto adoption rates are still quite low. So crypto has sort of an exponential growth opportunity because the adoption is increasing.
Hey, what's up everyone? Welcome back to the channel, where we explore the craziest stories, wild ideas, and things you won't believe are real. Smash that subscribe button and turn on notifications so you never miss a moment. Let's jump right in. First of all, let's talk about the history and how it started. And what is Bitcoin? What does Bitcoin do? Is it perfect? Neither was email when it was invented in 1972. This is the greatest Bitcoin explanation of all time. If you have a family member that doesn't quite understand cryptocurrency, send him or her this. They will thank you. Thank you for the opportunity to speak with you today. My name is Peter Van Valkenburg, and I'm the Director of Research at Coin Center, an independent nonprofit focused on the public policy issues affecting cryptocurrency and public blockchain networks. What is Bitcoin? Bitcoin is the world's first cryptocurrency, and it works because of the world's first public blockchain network. What does Bitcoin do? It's simple. It lets you send and receive value to and from anyone in the world using nothing more than a .540 Pi 57 computer and an internet connection. Now, why is it revolutionary? Because unlike every other tool for sending money over the internet, it works without the need to trust a middleman. The lack of any corporation in between means that Bitcoin is the world's first public digital payments infrastructure. And by public, I simply mean available to all and not owned by any single entity. Now we have public infrastructure for information, for websites, for email. It's called the www. Internet. But the only public payments infrastructure that we have is cash, as in paper money. And it only works in face-to-face transactions before Bitcoin. If you wanted to pay someone remotely over the phone or the internet, then you could not use public infrastructure. You would rely on a private bank to open their books and add a ledger entry that debits you and credits the person you're paying. And if you both don't use the same bank, well then, there'll be multiple banks and multiple ledger entries in between. With Bitcoin, the ledger is the public blockchain, and anyone can add an entry to that ledger, transferring their Bitcoins to someone else, and anyone, regardless of their nationality, race, religion, gender, sex, or creditworthiness, can for absolutely no cost create a Bitcoin address in order to receive payments digitally. Bitcoin is the world's first globally accessible public money. Is it perfect? No. Neither was email when it was invented in 1972. Bitcoin's not the best money on every margin. It's not yet accepted everywhere, it's not used often to quote prices, and it's not always a stable store of value. But it is working, and the mere fact that it works without trusted intermediaries is amazing. It's a computer science breakthrough, and it will be as significant for freedom, prosperity, and human flourishing as the birth of the internet and Bitcoin is just the beginning. If we can replace private payments infrastructure, then we can replace other private choke points to human interaction as well. Now, why should we want to build more public infrastructure? Why should we embrace blockchains over corporate intermediaries? Why should we tolerate their inefficiencies and work to make them better? Why should we want the pioneers of this technology here in the United States and not fleeing overseas? A simple reason: because the corporate intermediaries providing today's critical but privately owned infrastructure are becoming fewer, larger, and more powerful, and their failures are in critics increasingly grave. So roughly half of all Americans, 143 million people, had their social security numbers exposed to hackers because of a breach at Equifax. The SWIFT network has relayed hundreds of millions of dollars in fraudulent transactions because of hacked member banks in Bangladesh, Vietnam, Ecuador, and Russia. The FBI suspects now that the largest of these hacks was perpetrated by North Korea. Corrupt, low-level employees at an Indian bank, Punjab National, were able to fraudulently certify SWIFT messages, stealing $1.8 billion. It's the largest electronic bank robbery in history. In fact, it's the largest bank robbery in history. In October 2016, an estimated 2 million internet-connected devices were hacked and turned into a botnet that, for several hours, made prominent websites unavailable across Europe and North America, including CNN and Fox News, the New York Times, and the Wall Street Journal. Increasingly, physical machines are being connected to the internet to augment their capabilities. They're wired through servers that are owned and maintained by private and trusted intermediaries. The so-called Internet of Things pacemakers from St. Jude's Hospital have been hacked. Baby monitors from TrendNet have been hacked, and Jeeps from Jeep have been hacked to the point where they can be remotely commandeered and driven off the road. Now, those vulnerabilities are inescapable in systems that have single points of failure. It doesn't matter if the point of failure is a corporation or if it's a government. There shouldn't be a single point of failure. Similar choke points existed before the internet. If you wanted to deliver a message, you'd have to go through one of 3 television broadcasters or a handful of newspapers. Private corporations are essential, but no critical infrastructure should rely on 1 or 2. The internet removed single points of failure in communications infrastructure and ushered in a wave of competition among new media corporations. Building on top of its public rails, blockchains can similarly disintermediate critical payments and IoT infrastructure. The technology is not yet ready to answer all of those questions today, but it is our best hope. And as with the internet in the 1990s, we need a light-touch pro-innovation policy to ensure that these innovations flourish in America for the benefit and security of all Americans. And one more clip just to expand on that. Here is Brian Brooks, the former United States acting comptroller of the currency, explain the difference between Web 1, Web 2, and what cryptocurrency is Web 3. So the characteristic of Web 1, if people remember their original AOL account, was an ability to look in a curated walled garden at a set of content that was not interactive, but was presented to you on AOL the way that Time magazine used. To show you the articles they wanted you to see inside of their magazine, just you could see it on a screen. The innovation of Web 2 was that suddenly you could not only read content, but you could also write content. This is when the blogosphere became a big thing. People remember this from the late 90s, the early 2000s. And the reason for the centralization of the internet, of course, was that all of that activity was being monetized by a very small number of companies. Facebook is the chairman, the chairwoman mentions Google, and 2 or 3 other companies. What makes Web3 different is the ability to own the actual network, and that's what crypto assets themselves represent, is an ownership stake in an underlying network. So when you hear people talk about, for example, Layer 1 tokens, what they mean is this is your reward for providing the ledger maintenance services, the computing power to the network that on Web 1 and 2 was done by Google, right? So now people in my hometown of Pueblo, Colorado can actually own the Ethereum network, but they can't own the internet that's owned by Google and a few other companies. That's what the project Data of Crypto is all about, is allowing people to directly own the networks that have native assets that are supporting it. And that's the nature of decentralization, where the token holders are the people who control the assets, okay? Not the Google token holders. For our language here on the Hill, those are digital assets, right? Which are the keys to open up the ledger for you to participate, right? So describe to us how those digital assets fit into this internet revolution, Web3. So the concept is that you have sort of application layer tokens and you have protocol layer tokens. So if I'm an owner of Bitcoin, let's say that I'm a miner of Bitcoin, somebody who actually creates Bitcoin, the Bitcoin is the reward I receive for doing the work to keep the network operational, and that allows me to own a piece of the Bitcoin blockchain or take Ethereum, which is easier to understand. The Ether token represents an ownership stake in the network. But on top of that, network are all kinds of apps that get built on the network. Much like the apps on your phone, depend on the underlying network existing that lets the phone operate. And so people will make judgments about which network is likely to win, and they will invest in the tokens in that network, much the same way you might invest in Google stock because you think Google is going to scale access to the original internet. The difference being, here you can vote on what happens in the future of a proof-of-stake network. For example, you can get rewarded through a proof-of-work token for maintaining a ledger on something like Bitcoin. But the real message here is that what happens on the decentralized internet is decided by the investors, versus what happens on the main internet is decided by Twitter, Facebook, Google, and a small number of other companies. If you're interested in learning more about cryptocurrency, click subscribe. We drop a video every single day keeping you informed. See you tomorrow. Obviously, prices are down. I'm not going to sugarcoat that. But crypto has this bad habit of linking prices to performance of networks. The network has never been stronger, has never been more resilient, has never been more future proof to scale, having layer 2 plugged in and ready for the institutional moment than right now. Yep, asset price will follow. I mean, that's a foregone thing, and that's just a matter of when, not if. And now, what's the future of Bitcoin? Now we will talk about massive news today. There's a reason why Bitcoin is up. Why Ethereum is up. Why crypto is up. Traditional markets are down, but the uncorrelated asymmetrical asset class of Bitcoin and crypto is up. Why? Reason number one, Justin Bloomberg publishes report titled Bitcoin Nears, zone where past bear markets have bottomed out, comparing where Bitcoin and crypto is today to the 2022 bottom, 2018 bottom, 2015 bottom, 2011 bottom. Hundreds of millions of investors and institutional clients. Smart money. Read. Bloomberg. Get their information from Bloomberg. So articles like this have a ripple effect for the next couple weeks, for the next couple months, where Bloomberg's audience now is given permission to buy in mass and realize that there's more upside than downside and ahead. Now, the really interesting part is most people think of BlackRock's Bitcoin ETF as sort of a failure since crypto crashed in October. When you think of the spot Bitcoin ETFs, probably even BlackRock, which is the most successful. How many of you think of a chart that looks like this, just cratering since October? And here's where we are today. You are being fooled. If you think that this is the chart that matters, the chart you should be looking at is this one. And I'm going to have Robert Mitchnick of BlackRock explain it to you in just a second. But you just look at it. This is Bitcoin spot ETF, not priced in US dollars, but priced in Bitcoin. And you will see it's hardly down. When the price did crash, buyers stepped in, keeping the overall Bitcoin level up. And even if we just measure it from 2026, Bitcoin is just ticking up, positive in 2026. And it's not just BlackRock. It is every spot Bitcoin ETF steady accumulation. So let's get some inside information from BlackRock's Robert Mitchnick. Most people will ignore the information he shares in this clip, but listen very carefully to him articulate that 90% of investors have been steadily accumulating. There's a lot of confusion in crypto and in the crypto market right now, but $13 trillion BlackRock Robert Mitchkin clears up the data and actually articulates what you need to understand when it comes to Bitcoin accumulation in 2026. They are buying. I think what's really notable, and there's been some confusion, you know, in various corners of the internet about this, is how resilient those flows have been and how disproportionately long-term buy and hold fundamental type investors we've seen in these products. You take, Bitcoin and IBIT, for instance. Bitcoin down, almost 50%, obviously from its all-time high that it made in October. The flows in IBIT on a year-to-date basis are actually slightly positive. So there's been a lot of selling pressure elsewhere in the Bitcoin ecosystem on crypto exchanges on these offshore levered platforms. But the ETF investor base has taken a much steadier, longer-term fundamental view of things. The retail contingent actually are some of the most long-term focused that we've seen, and they've tended to opportunistically buy the dips. Kind of 90+% of the investor base, whether we're talking about retail, direct investors, we're talking about financial advisors, talking about other institutional investors, have tended to be very steady and have been on an accumulation path pretty consistently. If you look at 2025, the number of the top inflowing ETFs in the world that had negative price return, the top 20, there was only one, which was IBIT. So despite negative price moves in Bitcoin, IBIT was fourth in the world in inflows with 26 billion in. So we've just seen that steady accumulation pattern on a long-term basis, and Bitcoin exchange balance data confirms this. Just in Bitcoin, supply on exchanges heading towards new lows. This kind of stuff often happens when prices dip. Buyers step in at lower valuations and say, hey, I'm going to buy some. Now, Michael Saylor keeps buying Bitcoin at a greater rate than he's ever done at any bear market before. Do you realize that Michael Saylor buying Bitcoin today, very different from the first 5-6 years when Saylor got into Bitcoin? Why is Saylor buying more Bitcoin in a bear market today than any other down period ever in Michael Saylor's history? Well, it is because he has a string of financial products like Strike, which finally allows him to buy as much Bitcoin as he can when prices are low. Like Understand Saylor and Strategy always had a problem where their biggest Bitcoin purchases were when the price was going up and MSTR was going up. They could really only buy en masse when MSTR was going up. Well, now, because of their credit products like Strike, they could buy en masse when Bitcoin's price is down. So, Saylor buying is actually more bullish today than it ever has been. And that's why we're seeing such heavy accumulation from him. What I've said is if we get to 5% of the network, Bitcoin is going to be $1 million a coin. If I get to 7.5% of the network, it'll be 10 million a coin. Guys, Bitcoin leads the market. Hugely bullish on Bitcoin right now, but we are altcoin daily. So, subscribe to our channel. Let's talk about altcoins. We reported to you that this might happen just the other day, and it has finally been triggered. The altcoin Golden Cross has just been triggered. Every previous Golden Cross that preceded this, a major altcoin rally happened after. And so this structure is flipping right now. The Golden Cross has been triggered. The quiet phase for altcoins may be ending. And this is exactly what we're hearing from altcoin company leadership who say, behind the scenes, I'm sure you noticed, there is a shift in users. There is a shift in who is buying crypto, who is adopting crypto. It's no longer retail, guys. It's institutions and Wall Street. Listen to Ava Labs president John Wu articulate why crypto is different today. blockchain has literally gone from crypto assets 7 to 10 years ago to now enterprise technology. There's an entire changing of the guard, if you will, not just in terms of the investors, but also the types of developers, the types of users. What we're seeing is the developers are more and more enterprise-oriented. The users on-chain are different type as well. They're higher on the adoption curve. They're not the early, innovative type adopters. They're the early majority, if you will. So it's a changing of the guard in many ways. If you're bullish on Bitcoin because Michael Saylor sets the floor and he buys week after week, and we know he's going to continue buying week after week, perhaps you should be bullish on Ethereum. This is Ethereum's cycle to lose. So first of all, Tom Lee is the Michael Saylor of Ethereum. Most people do not realize he buys $100 million worth of ETH every week. Bitmine's been buying about $50,000 or about 100 million of Ethereum every week. But the cash balance has grown to over 800 million. So it's able to, at the right moment, make a major buy of Ethereum. So I think we're getting ready for the crypto bottom, but we're still buying about 100 million a week. But like Ethereum has a lot of Michael Saylors. So for instance, Etherealize is like Bitmine, and Vivek here is like Tom Lee. So listen to how bullish things are for Ethereum this cycle. Again, I think this is an example of preparation meets opportunity for Ethereum, as he articulates here. Money market funds on Ethereum have multiplied. Stablecoins on Ethereum going parabolic. Now, Larry, Fink coming out and saying we need one common blockchain so we don't have fragmentation and all tokenized assets can be in one place. You know that BlackRock is using Ethereum for this, and Ethereum in general is best set up for this. This is why you should be bullish on Ethereum. The truth about markets, especially in crypto, is that they rarely reward emotion, but they often reward patience. While prices move fast and headlines shift daily, the real story unfolds quietly beneath the surface. Adoption grows, infrastructure improves, and long-term players position themselves before the crowd even realizes what's happening. This moment, where uncertainty is high and confidence feels shaken, is often where the strongest foundations are built. Not every prediction will come true, and not every project will survive, but the broader shift toward digital assets, decentralized systems, and institutional involvement is already in motion. Whether this is the exact bottom or just another phase in a longer cycle remains to be seen. What matters more is understanding the direction of the trend, managing risk wisely, and staying grounded in reality, not hype. In the end, markets don't move because people are excited. They move because value is recognized over time. And in crypto, that recognition has always come when the majority least expects it. Stay informed, stay patient, and most importantly, stay disciplined.